The sky is falling. The sky is falling.
Chicken Little might be forgiven for believing the world had ended when an acorn hit his head. Similarly, we may be inclined to forgive the prominent investment strategists who declared 2023 would see our economy decline and capital markets fall because of the Fed's extraordinarily aggressive rate hikes. To be sure, the Fed's rate hikes have been brutal. As shown in this chart, the Fed raised interest rates from 0.25% to 5.25%. This is a multiple of 21 times. Historically, rate hikes only end when something breaks. Therefore, at the beginning of 2023, most equity strategists predicted a recession and another bad year for investors. Historically, it has been hard to crush inflation without crippling the economy. The good news is that throughout 2023, inflation was meaningfully lower. Our economy undaunted, and the capital markets are up. From the November 17, 2023 weekly headings, we read:
Inflation has cooled considerably over the last year, falling from a peak of 9.1% in June 2022 to just 3.2% currently.
Reviewing the specific components of inflation in a chart provided by J.P. Morgan's Guide to the Markets, we see that all elements have fallen. Shelter is the largest remaining component, and energy prices have turned negative. On the left of this chart, we show components for headline CPI inflation. The right shows the components for Chairman Powell's super core measure of core services, excluding housing, which is a key measure of inflation that the Fed uses. Both charts illustrate there is no need for continued tightening. Despite our marked progress, several remain convinced that the Fed cannot engineer an economic soft landing from such an elevated increase in interest rates. Some, like those profiled in the article titled "Stocks Have Taken, Is a Bear Lurking Around the Corner?" argue that the market is missing one thing or another that only they can see. This notwithstanding the fact that the United States economy has grown, as illustrated in this chart. Those that predicted a recession in 2023 have been wrong, dead wrong. The U.S. economy grew, bolstered by a strong consumer enjoying record unemployment and record net worth. Please see the detailed notes on the economy and our labor market from the most recent November 17, 2023 weekly headings here.
A resilient consumer and strong labor market have helped the U.S. economy sidestep a recession thus far. In fact, the U.S. economy grew at its fastest pace since the fourth quarter of 2021, rising 4.9% in the third quarter of 2023. With the U.S. economy adding 8.4 million jobs over the last 24 months, more people working has helped propel consumer spending. In fact, a record 161 million Americans are now employed, above the pre-COVID high of 158.5 million. Wage growth has also been healthy, with average hourly earnings increasing 4.4% over the last year, outpacing the rate of inflation, which is about 3.2%.
Indeed, we see from this chart with data compiled through the end of September provided by J.P. Morgan, that the unemployment rate at 3.8% is lower than its historical average of 6.2%. And wage growth at 4.5% is above its long-term average of 4%. We currently forecast a short, shallow recession in the first part of next year. Specifically, from the first article, we read:
While we expect the U.S. economy to enter a recession in the first half of the next year, solid consumer and corporate fundamentals should ensure that it is one of the shortest and mildest recessions going back to 1945.
Far from being a calamity, a short, shallow recession may provide the compelling pretext the Fed needs to end one business cycle and inaugurate a new business cycle with rate cuts. It bears considering that where we are in the business cycle depends on the industry and geography. From even a cursory review of these charts, we realize some industries and economies are emerging from recession and resuming growth, while others are declining. We may do well to carefully consider the merit to blanket the sky as falling declarations of economic and capital market collapse. It may be more robust to conclude that we have been in a rolling recession as illustrated in this chart. The remarks by Ed Yardeni, in a video titled U.S. Economy's Rolling Recession Turning into Rolling Expansion, seem thoughtful. Furthermore, it is important to note that in this year, the capital markets as measured by the 60/40 stock-bond portfolio in this graph are up by 5% through the end of September 2023. Over the past 43 years, the stock market has been positive 32 times, or 74% of the time. This is consistent with what we have shared in the past, 70% of the stock market advances. Looking forward, we may ask, what may we anticipate next year? The tendency is to rely on the most accurate analyst from the prior year. In 2022, Morgan Stanley's Mike Wilson ranked as the #1 strategist in Institutional Investor Survey. Mike is notorious for being negative about the markets. His bearish predilection matched the epic 18% decline in the stock market in 2022. However, the year of 2023 has confounded his oft-repeated call for the stock market's collapse. 11 months through the year, Mike is still bearish. On November 4, 2023, Morgan Stanley's Mike Wilson says year-end rally unlikely. The problem with being a bear in a bull market is that you may miss precious opportunities to advance your clients' interests. Please see this chart of the performance of the stock market since October 27, 2023, as represented by the S&P 500 in purple and the Nasdaq in green. However bad we may feel about the world and its current trials and challenges, it is hard to deny the following three facts. Inflation has fallen, the economy has grown, and capital markets have appreciated. Clearly, an overly bearish orientation to investing has been wrong. Those that have sold the market short have suffered cataclysmic defeats. Consider Jim Chanos, the short seller who called Enron's fall as closing his hedge fund after suffering cataclysmic losses on his backward bet against the S&P 500 this year. This chart shows that the S&P 500 and the Nasdaq capital markets have been a roller coaster to be sure. However, as we come to the final moments of the year, we must acknowledge, as Larry Adams' November 17, 2023 weekly headings remarks, the stock market has appreciated this year.
Following the worst annual performance since 2008, 2023 was the first year in 2 decades that strategists, in aggregate, forecasted a negative year for the S&P 500. However, we are thankful that has not occurred as the S&P 500 is on pace to rise 20% on a total return basis. The 6 mega-cap tech-related names are up 69% year-to-date, accounting for over 75% of the returns for the S&P 500. However, ex-Magman, the S&P 500 would be up only 6%. The bond market has faced unprecedented losses over that last 2 years as the Fed rapidly raised interest rates to respond to rising inflation pressures. Bonds now provide healthy income and some of the most compelling valuations relative to other asset classes in over a decade.
As we come to the end of the year, we may do well to rely less on feelings, predilections, and preferences, and assess the data. Consumer spending is the largest component of our economy. It may be accurate to assert, as goes the consumer, so goes our economy. Please see this chart. The consumer is doing fine. Goldman Sachs Strategic Advisory Solutions November 2023 Market Pulse argues that continued job gains and positive wage growth in the U.S. could lead to real income growth of 3% and 4% in 2023 and 2024 respectively. As a result, we expect consumer resilience despite subdued sentiment. We will keep an eye on this, as the consumer would certainly be hurt should our economy meaningfully slow down. However, none, not one, of the determinants of recession have rolled in as we see from this chart. Moreover, the strength of the current labor market does not currently portend a meaningful decline in employment. It may be useful to remember, as cited in the attached November 17, 2023 weekly headings.
With the number of job openings still outpacing the total number of unemployed workers for each of the last 29 months, we expect more muted job losses relative to history during the next recession, as businesses will be reticent to lay off employees given the struggle to find qualified workers in the post-pandemic period.
The markets seem to concur, as reflected in the rise in the S&P 500 since the end of October. Indeed, as we see from this chart, we may be in the heart of the best part of the year for capital market returns. Goldman Sachs' November 2023 Market Pulse cites the relevant research to argue that we may finish the year strong, saying historical periods of S&P 500 total returns greater than 10% from January through July, followed by a drawdown from August through September, have yielded strong fourth-quarter returns. Specifically, the index has provided fourth-quarter returns of 6.3%, on average, while delivering positive performance in every instance. The sectors of the economy that may most appreciate a more favorable interest rate environment may be an advantageous place to start. There are two reasons why. Number 1, these are currently inexpensive. Number 2, lower interest rates may enable these companies to experience an acceleration in earnings. As an example, please see the recent underperformance of real estate investment trusts REITs in light blue in this chart. Continuing the example, from this chart, we note that REITs were the best performing asset class in 2021 after being the worst in 2020. Going forward, the asset class may represent a compelling opportunity. Why? Most finance real estate with debt. The Fed has made debt capital expensive. Companies with excessive debt have underperformed. It may be reasonable to expect that as our economy slows, the Fed may have grounds to pivot. Since capital markets tend to anticipate what it may be useful to consider now where capital will flow into next. From the institutional equity strategy Tavis McCourt, we see a chart illustrating that companies with leverage have underperformed, but may represent an opportunity going forward. Finally, far from falling, the sky may be clearing of the clouds associated with the Fed's onerous rate hikes. As we celebrate the holidays, we may be grateful for a more favorable end to 2023 than we suffered in 2022. This final chart helps us remember that troughs in consumer sentiment, the times when we feel bad investing, are typically the very best times to invest. We see that, on average, investing during the 9 troughs in sentiment yielded an average annualized return of 24.1% in the year after the trough. This is more than 6 times better than the 3.5% average annualized return for those that invest when things are dandy at peaks in consumer sentiment.